Imagine waking up one day, and instead of counting coins, you hear the cha-ching of money landing in your account just because you own some pieces of a company. This isn't just fantasy talk. It's about making your money work for you so you can live freely without worrying about cash all the time. This video is about learning the quickest way to live off of your dividends or passive cash flow from your investment portfolio. We have done extensive research on ways to optimize your income to generate thousands to build your wealth. Our channel is run by a millionaire with a bachelor's in finance and MBA with 20 years of investing experience. Let's teach you what we already know. Everyone knows about dividends, but very few know what we are going to cover today: the secret sauce. Have you ever been really frustrated because the stocks you invested in aren't performing as well as you hoped? Every day you check the stock market, hoping for some good news, but it feels like the numbers just aren't in his favor. You thought you'd make some money and see his investments grow, but instead, there's barely any progress. We have all been there. This situation isn't just about the financial loss. It's also making you doubt your choices and whether you are good at investing. But have no fear. You don't necessarily need a bunch of capital appreciation in your stocks. You can instead choose to focus on those recurring dividends that are like money coming into your mailbox on the regular. But before you can know the specifics, you need a plan of action. Knowing how much cash you need to live your dream life is key. It's like planning a road trip. You need to know your destination before you start driving. Everyone's dream is different, so while some folks might be okay with a cozy lifestyle, others might want a bit more luxury. Determining a sustainable distribution amount from an investment portfolio to ensure it lasts through your retirement years involves several key considerations. One of the most cited rules in financial planning is the 4% rule, which suggests that you can withdraw 4% of your portfolio in the first year of retirement and then adjust that amount for inflation in subsequent years to have a high likelihood of your portfolio lasting 30 years. To figure out how much money you need saved up to cover your expenses in retirement, you start by deciding how much income you want each year from your investments. Let's say you decide on a rule where you only take out a small percentage of your savings every year to make sure it lasts. For example, if you want $40,000 a year to spend in retirement, you would work backward from there. You divide the amount you need each year by the percentage you plan to take out. So if you're following the 4% rule, you divide $40,000 by 0.04, which represents 4%, and you find out you need to have saved up $1 million to start with. If you're a bit more cautious and prefer to only take out 3.5% of your savings each year to make it last longer or to be safer in unpredictable markets, you divide your annual need by a smaller number, 0.035. Doing this for $40,000 would show you need about $114 million saved up. But remember, this is a simple way to start planning. You have to consider that the amount you take out will likely need to go up over time to keep up with the cost of living, and how the stock market performs can also affect your savings. Plus, if you have other income coming in from places like Social Security or a part-time job, you might not need to take out as much from your savings each year. It's also wise to revisit your plan now and then, especially as markets change and as you get a better idea of what your retirement looks like. At the end of the day, it's all about setting your goals to match your dream. Imagine having a money tree in your backyard, growing dollars instead of leaves. That's what investing wisely can do for you. Ready to find out how to plant that tree? Next, we'll look at a cool way to make money through dividends, your money-making babies. Did you ever wish that you got a pension where you could get mailbox money on the regular to help cover your expenses each month? Well, those days are gone, as most companies don't offer a pension plan anymore, and almost all of us will only have Social Security, which will cover a fraction of our income replacement. As investors, what can we do? What if I told you a way to build our own pension one share at a time? Well, what you need are dividends. Let's break down what a dividend is. Imagine you own a tiny piece of a big company. When that company does well and makes profit, they can decide to share some of that money with you just because you own that piece. It's like having a friend who gives you a slice of their birthday cake just because you're friends. Some companies give out these slices every few months. Knowing how much cake or money you'll get compared to how much you paid for your piece of the company helps you pick the best investments. It's a way to make your money grow without having to do extra work. Now, wouldn't it be great to have a steady flow of cake slices coming your way? Let's explore how to make that happen. Strategy 1. The quicker path. Have you ever been frustrated at the lack of significant dividends in companies? Wishing that a company's leadership would just increase the company's dividend? Do you wish there was a better way? Well, what if we told you there is? There is a quicker path to creating dividends in your portfolio. Let's open the secret now. One shortcut to making money through dividend is by investing in something called covered call ETFs. Think of it as owning a part of a basket of stocks that also tries to earn extra money by renting out the stocks to others. It's a bit like having a lemonade stand and also renting out your lemonade pitchers for extra cash. These special funds can give you money both from the stock going up in value and from those rental fees, which means more cash for you. But remember, all investments have risks, like if no one wants to rent your pitchers. If you're aiming for thousands of dollars as a monthly goal, starting here could get you there faster and with less money up front compared to other methods. Interested in how this magical basket works? Let's keep going on how to practically invest in covered calls. Covered call ETFs are investment funds that aim to generate income through the sale of call options on the assets they hold, typically stocks. These ETFs can provide investors with a regular income stream in addition to the potential for capital gains from the underlying stocks. Here are 3 examples of covered call ETFs. 1. Global X NASDAQ 1200 Covered Call ETF QYLD. This ETF seeks to provide investment results that correspond generally to the price and yield performance before fees and expenses of the CBOE NASDAQ 100 Buy Right V2 Index. The strategy involves holding a portfolio of the stocks in the NASDAQ 100 index and writing selling call options on that index. 2. iShares S&P 500 Covered Call ETF PBP. PBP aims to replicate the performance of the CBOE S&P 500 Buy Right Index. By owning the stocks in the S&P 500 and selling call options on the same index, this ETF seeks to offer investors potential income from option premiums in addition to the growth of the S&P 500 stocks. Now let's look at another dividend strategy to wealth that you may not expect. Strategy 2. Building wealth with REITs. Have you been feeling the struggle at the grocery store lately with inflation? Prices are up month over month and there is no stopping. Inflation has been a challenge as of late, and as investors, we look for ways to stop the upward price spiral. Well, one way to do that is to invest in an asset class that God stopped making a long time ago: real estate. More specifically, publicly traded REITs are an asset class that typically hedges you from inflation while providing good income along the way. REITs are companies that own things like malls, apartments, and offices. They make money from these properties and share the profits with you. It's as if you owned a piece of a shopping mall and got a cut of the rent money. Some REITs are like the golden geese of investments, offering high returns, which means more money in your pocket. However, just like any investment, there's a risk, especially if the economy hits a rough patch. But with a smart plan and consistent saving, you could reach your financial freedom goal in 5-7 years. Wondering how much you'd need to invest to hit your dividend target with REITs? Let's look at some investment options. Real estate investment trusts, or REITs, are companies that own, operate, or finance income-producing real estate across a range of property sectors. These companies offer investors of all sizes the opportunity to own valuable real estate, present the opportunity to access dividend-based income and total returns, and help communities grow, thrive, and revitalize. REIT ETFs are exchange-traded funds that invest in portfolios of REIT stocks, allowing investors to gain broad exposure to the real estate sector. Here are 3 examples of REIT ETFs. 1. Vanguard Real Estate ETF, VNQ. This ETF seeks to provide a high level of income and moderate long-term capital appreciation by tracking the performance of the MSCI US Investable Market Real Estate 2550 Index. The index includes stocks of publicly traded equity REITs and other real estate-related investments. VNQ is known for its broad exposure to the real estate sector and its low expense ratio, making it a popular choice among investors looking for real estate exposure in their portfolios. 2. iShares U.S. Real Estate ETF, IYR. IYR aims to track the investment results of an index composed of U.S. real estate equities. It provides exposure to U.S. real estate companies and RREITs, which invest in real estate directly and trade like stocks. The ETF offers diversification across various subsectors of the real estate market, including commercial, residential, and healthcare real estate. REIT ETFs can be an efficient way to invest in the real estate sector, offering potential for income through dividends and opportunities for capital appreciation. They also provide liquidity and diversification benefits, which can help reduce risk in an investment portfolio. Now onto another great way to generate income. Strategy 3, the steady climb. Are you ever frustrated as a dividend investor when you check your portfolio one morning and notice that your one higher yielding stock is down big? Turns out that stock cut its dividend, or worse, it eliminated it entirely. This is a huge problem if you are an income investor. But how can I avoid experiencing this pain? There are 2 ways that you can use to help prevent this bad outcome. Firstly, you can look at the payout ratios for companies. Payout ratio is the percentage of net income, profits, a company pays out on an annual basis. Data suggests that you don't want to buy companies with more than a 70% payout ratio to avoid buying a company that may cut its dividend. This is because if a company is paying out more than 100% of its profits, the sustainability of the dividend is in question. A no-no. Secondly, dividend aristocrats are like the honor roll students of the stock world. They're part of big, reliable companies that have been increasing their dividends for 25 years or more. It's like having a friend who gets better at video games every year and never lets you down. Investing in these companies might give you smaller dividends than rates or covered call ETFs, but they're super reliable, making them a safe part of your money-growing strategy. To get that thousands monthly income, you'd need a bigger upfront investment, but it's still less than what you'd need with regular stocks. Plus, spreading your money across several of these all-stars can help keep your investments safe. Ready to see how this could work for you? ETFs that focus on dividend aristocrats aim to offer investors exposure to these companies, potentially providing a steady stream of income along with capital appreciation. Here are 3 examples of ETFs that invest in dividend aristocrats. 1. ProShares S&P 500 Dividend Aristocrats ETF, NOBL. This ETF seeks to track the performance of the S&P 500 Dividend Aristocrats Index, which is composed of S&P 500 companies that have increased dividends every year for at least 25 consecutive years. Noble aims to provide investors with a reliable source of dividends combined with the potential for growth. 2. SPDR S&P Dividend ETF, SDY. SDY focuses on the high-yield dividend aristocrats index, which includes companies that have consistently increased their dividends for at least 20 consecutive years. While it has a slightly different criteria than the S&P 500 Dividend Aristocrats, it still targets companies with a strong history of growing dividends. 3. Vanguard Dividend Appreciation ETF, VIG. Although not exclusively focused on dividend aristocrats, VIG aims to track the performance of the NASDAQ U.S. Dividend Achievers Select Index, which includes companies that have increased their annual dividends for 10 or more consecutive years. Many of the companies in VIG's portfolio are also considered dividend aristocrats. Investing in these ETFs can provide a diversified approach to gaining exposure to companies with a strong history of dividend growth. Such investments can be particularly attractive to those seeking steady income in addition to potential capital gains from their equity investments. Now that we've explored 3 strategies for earning dividends and getting closer to financial freedom, it's all about taking the first step. Whether it's covered call ETFs, high-yield REITs, or the steady approach with dividend aristocrats, the key is to start somewhere. Before you start procrastinating on this topic, as we all can do, remember the journey to making your money work for you is a marathon, not a sprint. It takes planning, patience, and a bit of courage to invest in your future. So what's your first move going to be? Let's get ready to make those dreams a reality, step by step. Your path to financial freedom. We all had times we worried about money, right? When you check your balance at the bank and it's hovering around zero, well, it's time to snap out of the funk. Dreaming of a future where you don't have to worry about money is great, but making it a reality is even better. By understanding how dividends work and exploring different investment strategies, you're taking the first steps toward financial independence. Remember, a person is resting in the shade today because a tree was planted 50 years ago. Plant those seeds. Whether you're drawn to the juiced income with covered call ETFs, the solid total returns of REITs, or the lower income but higher reliability of dividend aristocrats, the most important thing is to start investing now. Each strategy has its own path to help you reach your goal of thousands a month in passive income. So why wait? Begin your journey to financial freedom today and watch as your money starts working for you. If you want to evaluate another rarely used but awesome income-generating option, you should look into this with our detailed video on that topic here. We promise Thai never-before-seen strategy will provide you a unique perspective on top of what you learned here today to supercharge your yield even more. Thanks for watching. This is not financial advice. Withdrawal Investing Insights, signing off.